So, you're a small business owner in Canada. You know that getting the right equipment is an absolute game changer. But here's the real question, right? How do you actually get that gear without totally emptying your bank account or, maybe even worse, creating a tax nightmare for yourself? Well, that's exactly what we're going to break down.
Should you lease it or should you buy it? Look, this isn't just about money. It's a huge strategic decision. And the choice you make right here, it's going to have ripple effects on your cash flow, your balance sheet, and yeah, your tax bill for years to come.
You know, when you strip it all down, this whole decision really comes down to two mindsets. Are you a renter at heart? Someone who values flexibility and keeping those upfront costs super low? Or are you an owner, focused on building equity and having total, absolute control over your assets?
All right, before we dive headfirst into the nitty-gritty tax stuff, let's just take a second and make sure we're all on the same page about what leasing and buying really mean for your day-to-day business.
Okay, so leasing. Just think of it like a long-term rental. For a set amount of time, let's say 2 to 7 years, you make regular payments to use a piece of equipment. Now the key here is that you don't actually own it. When the lease is up, you usually have a few options. You can send it back, you can renew the lease, or sometimes you can buy it. Simple, right?
Now buying, well, it's pretty much what it sounds like. You pay for it, either with cash you've got on hand or with a loan, and boom, it's an asset on your company's books. From that second on, it's all yours. And I mean all of it. The good, the bad, and the broken. Maintenance and repairs are now your problem.
Okay, now for the part you've really been waiting for, the taxes. This is huge because how you get your equipment completely changes how the Canada Revenue Agency, the CRA, looks at the deal. And trust me, how they see it determines every single tax benefit you can get.
First up, let's talk about the operating lease. And you're going to love this one because the CRA sees it as a straight-up rental. It's so simple. Your lease payments are just a normal business expense, which means they are 100% tax deductible in the same year you pay them. It's all about getting that immediate tax relief. But then we've got its tricky cousin, the capital lease. Now this is where it gets interesting, because even though it has lease in the name, the CRA basically treats it as a purchase in disguise. So no, you can't just deduct the payments. Instead, you have to depreciate the asset over time using something called the capital cost allowance.
And looking at this side by side, you can really see the difference, can't you? With an operating lease, you write off all your payments for the year right away. When you buy, you only get to write off a little piece of the cost each year through depreciation. Plus, leasing keeps that debt off your balance sheet while buying adds both an asset and a liability. It's a big deal.
Okay, so I've been throwing this term around. Capital Cost Allowance, or CCA. It sounds complicated, right? Well, don't worry, it's really just the official government speak for depreciation here in Canada. It's the CRA's rulebook for how businesses have to write off the cost of an asset over its lifetime, and they have very specific rates for everything.
So, how does it actually work? Well, it's pretty structured. First, you have to figure out which class the CRA puts your equipment in. Then you find the depreciation rate for that specific class. And finally, you deduct that amount from your income. But here's the catch. You have to do it year after year, spreading it out over a long time.
All right, I know. Enough with the taxes for a second. Because as important as they are not the whole story. Let's zoom out and look at the bigger picture. The real impact these choices have on your actual day-to-day business.
Wow, and this chart just says it all, doesn't it? This right here is the biggest deal breaker for most small businesses, cash flow. Buying demands a huge pile of cash up front, tying up capital you could be using for other things. But leasing, it often takes little to no money down, which keeps your cash free for critical stuff, like payroll or, growing the business. Let's break that down even more. When you lease, you get nice, predictable monthly payments. Sometimes maintenance is even rolled right into the deal, and you don't have to worry about your tech getting old, you just give it back. But when you buy, you're on the hook for absolutely everything. The massive initial cost, every single repair, and the huge risk that your brand new machine will be a relic in just a few years.
Let's put some real numbers to this, okay? Let's say you need a $90,000 piece of machinery. Instead of somehow finding that 90 grand in cash, you could lease it for something like $1,800 a month. I mean, think about that. That frees up a ton of working capital that you can pump back into your business right now.
Okay, we've gone through the what, we've gone through the how. Now it's time for the big question. What should you do? Let's take everything we've talked about and build a simple framework so you can make the right call for your business.
You know, this quote right here just hits the nail on the head.
If your business is growing like crazy, or maybe things are a little bit uncertain, then cash flow is king. It's everything. And in those situations, leasing can give you the breathing room you absolutely need to stay quick on your feet.
So let's make this super simple. You should probably be leaning towards leasing if your cash flow is tight, you want those immediate tax write-offs, or the tech you need changes every 5 minutes. Basically, if you value flexibility and predictable costs, leasing is probably for you.
But what about buying? Well, that's the power move you make when your business is stable and you've got strong cash flow. Buying makes sense if you know you're going to use that equipment for a decade or more, and you really want to build up that asset equity on your balance sheet for the long haul.
Okay, one last thing before we go, and this is super important because it's a myth that trips up so many business owners. A lot of people just assume that if it's a lease, you can write off every single payment, no questions asked.
Yeah, that's just not how it works. Here's the reality, and if you remember just one thing from this whole explainer, please make it this. Only operating leases are treated as a simple, fully deductible expense. If your agreement is actually a capital lease, the CRA says it's a purchase and you have to follow those slow, complicated depreciation rules.
So there you have it. Choosing between leasing and buying, it isn't just a math problem. It's about your entire business strategy. It's about making sure this one decision lines up with your cash flow, your tax plan, and your vision for the future. The rules are on the table. The choice is yours. So which path is going to be the one that fuels your growth?